We've spent much of this year talking to our clients and hearing them explain how inflation is impacting everything they do, from the cost of financing and debt sources that they have available, to cross-border flows that they're looking to mitigate, to investments that they're making in supply chain and reducing the impact of commodity price increases. It's incredibly difficult to predict what will happen from a geopolitical standpoint, but if we think back 3 years ago, no one saw COVID coming. If we look back even a year ago, while there was a lot of chatter about Russia invading Ukraine, there wasn't nearly the degree of analysis that's gone in after the fact. And so we don't know what the next event will be, but we do know that there are some monumental events happening throughout the globe. The first is, of course, the Russia-Ukraine war. Price of gas is going up. Citizens are, as we enter winter months, going to have a significant challenge with being able to pay their heating bills. But it also has an impact on things like crop production. Russia and Ukraine are very large producers of wheat, and a lot of that wheat goes to some of the poorer countries in the world. And while production has stood up surprisingly well, and distribution has stood up surprisingly well, it's not clear that that will continue to happen. The second big area is China. In this case, it's really specific to China's zero COVID policy. Anytime there's a COVID flare-up in China, they have been shutting down that part of the country, and that's having a very significant impact on supply chains, and companies are starting to rethink their reliance on China as a manufacturing partner and some of the relationships they have with their suppliers in China. And finally, the last area that's always on investors' minds are large-scale political events and elections. All throughout Latin America, we see significant events and a lot of polarization in places like Brazil. Of course, there are midterms coming up in the US. There's a new prime minister in the UK, just to name a few. The commodities markets are always volatile, and uniquely to commodities markets, there's always a link between the financial and the physical. And this past few years, we have seen the impact of that link between financial and physical. The energy markets have been experiencing shocks like we haven't seen before, starting with Russia-Ukraine, but even going now to unprecedented temperatures that we've seen in Europe, California, the impact that that's had on the grid, the prices paid for electricity. When you combine all this, countries are having to rapidly rethink their energy infrastructure. Budgets have gotten blown out of proportion from what companies expected. And so we're seeing more discussion of how do we manage this risk going forward. But those are longer term investments. And in the short term, this rapid rise in energy prices has an impact on cost of goods sold. Central banks have to take this into account, even though they have zero control over it. The current scenario that we're facing with respect to energy prices and input costs is rooted in a variety of challenges, including the fact that there's been massive underinvestment. When these companies have actually drilled for oil, tried to increase supply in years past, we've seen a drop in prices, which has led to negative returns for investors. And so now there's a lot of incentive to say, well, we're generating some good returns. Let's send that back to our investors rather than reinvesting that into more supply, which is what the world needs right now. We have seen the most aggressive Fed action, ECB action, some of the most aggressive action that we've seen in central banks around the world as they deal with the current inflationary environment into what seems to be a much more certain recession. The dollar continues to strengthen in the face of that, having broken parity recently against the euro. And as a result, we're seeing our clients really changing some of their approaches. We are seeing companies for the first time in some cases really having to assess that cross-border risk. We've seen large investors in the private equity space and real estate space get pressured by LPs to evaluate and put in place a plan to mitigate that FX risk. We've seen companies that had never hedged before come out of the woodwork and say, our earnings can't withstand this level of volatility and this level of strengthening of the dollar. What can we do? We've seen investors, as they're looking to do a cross-border acquisition, even if that's going to close in 2 months, 3 months, 6 months, 9 months, say, I don't know what's going to happen between now and then. I really need to put in place some protection for this transaction. Whereas that same company just a few years ago would have never considered doing that and would have considered self-insuring. As we think about the future, this trend that we've seen over the course of the last several months, we see very much continuing into later part of this year, early part, and probably throughout 23 until we get to a little bit more of a coordinated approach globally that leads to a little bit more consistency in how different economies are performing. But until that happens, or until there's some other big shift that comes about to change the market tone, the focus on cross-border risk is very real and very significant for all types of investors. One challenge for companies as we look at the impact of this unprecedented action from central banks across the globe is the level of market volatility that's associated with it. This is a level of volatility we just haven't seen in a long period of time. Multinational companies that have been using cross-currency swaps have actually been restructuring these at a clip that we haven't seen before, often restructuring them to reset rates and pull cash out. But we've seen companies pull out anywhere from tens of millions to hundreds of millions of dollars over the course of the last year as the dollar has continued to strengthen. If the dollar does continue to strengthen going forward, companies should keep looking at this type of structure. A challenge that companies face is that it's a very different market environment than what they might have been used to during a period of relative calm over the last few years. The static programs that companies maybe had in place before, and that may have been a we don't hedge or this is what we do robotically, may not work going forward. It requires much more active assessments of what the risks are and how much a firm is willing to pay to take away some of that risk and what the benefit of doing so is. With the rapid pace of changes that are happening amongst all of our clients across multiple industries, we are seeing continued investment in digital transformation. The combination of using data and business intelligence tools that are embedded within our Chatham Direct software enable decision makers to make key decisions much more quickly. We see more and more of our clients walking into meetings with executives with dashboards that allow them to answer those key what-if questions. What if X happened? What if Y happened? What's happening in the market that's impacting our portfolio? And how could it impact us in the future? The ability to do all of that quickly on the fly has really sped up decision-making at a number of our clients. As our clients are going through this transition from LIBOR to SOFR and other alternative indices, they've been increasingly reliant on our technology, our software, and our models to help determine what the impact will be across all of their debt and their derivatives portfolio. They're using this to analyze the cost, the different alternatives that they may have, and ultimately able to track the outcomes of their decisions by leveraging our platforms as they go forward in a post-LIBOR world. Companies of all stripes across all industries are facing are systems challenges. Systems are not well set up for moving from one index to another. We have clients that are telling us how manual of a process this is. We have clients that have been investing for years that are still not in a place to be able to easily execute on this transition because of these systems challenges. And as a result, this is leading to a little bit of a delayed transition, and we know the clock is ticking. The consequence of all of this is, as we look forward, is that we feel there could be a bit of a traffic jam as we get into the second quarter of 2023, as companies continue to invest in systems and the tools they need to be able to make this transition. We we could find ourselves in a place where we have a lot of transition happening in a very small period of time, creating some incremental volatility in markets. So for those that have large portfolios, it can make a lot of sense to actually start stepping into the transition rather than transitioning everything all at once away from LIBOR, to take small steps into the transition away from LIBOR to a successor rate, some version of SOFR.